Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Brazen. Let's get you guys up to speed with everything you need to know at 3 p.m. Eastern Time. Headline inflation coming in as expected, but the Fed's preferred gauge lands hotter than forecasted, potentially complicating tightening plans. But what does this number actually mean, and how exactly does it measure inflation? We've got you covered with an in-depth look at the CPI print.
Plus, stocks jump as financials rebound after the collapse of Silicon Valley Bank. Attention turning to the role of lawmakers in preventing more contagion. Maxine Waters weighs in on Yahoo Finance Live. We got that interview in just a bit.
And Shark Tank star Kevin O'Leary giving us his take on the Silicon Valley Bank collapse. He will tell us why he thinks management should take the largest blame in this scenario here.
But first, a fresh read on inflation today in the form of CPI. The headline number coming in as expected, up 0.4% month over month. In February, 6% year over year. Inflation, yeah, it remains hot. But let's take a step back. What does CPI actually mean? How does it measure inflation? CPI, as defined by the U.S. Bureau of Labor Statistics, is the measurement of monthly change in prices paid by U.S. consumers. Now, the index tracks up to 100,000 goods and services a month. We're talking categories like housing, food, transportation, and apparel. The Bureau of Labor Statistics, commonly known as BLS, gives each category a relative importance based on a survey of what consumers buy.
All right, well, 450 workers at the BLS, they're responsible for tracking all of the prices, and they oversee 8,000 households. Now, to make sure that products haven't changed in price too much, they do compare a product, let's say eggs, for example, to a list of data points from the month prior. That means that these BLS workers, they are tracking the price of eggs from past months based on things like its size, its brand, and also labeling.
But the index does not include everything. The Fed prefers another measure called PCE. The index is a measure of the prices that people living in the United States or those buying on their behalf pay for goods and services. The Bureau of Labor Stats produces the CPI, while the Bureau of Economic Analysis produces PCE. CPI transitions items in and out of basket every 2 years, where PCE changes every month based on consumer trends. The Fed takes both into account when making decisions, which gives the Fed a general picture of where inflation is heading.
All right, well, inflation is just one of the things that the Fed is considering, because right now we are just 8 days away from that next policy decision, and there's still no consensus out on the street as to what the central bank is going to do. Goldman Sachs and Barclays both making the case for the Fed to pause their rate hikes following the collapse of Silicon Valley Bank. But Morgan Stanley, on the other hand, still seeing a path to a 50 basis point hike. And then we also got that CPI print out this morning. Well, we want to bring in Veronica Clark. She's an economist at Citi. And Veronica, there's lots to unpack here, but let's first start with that inflation print, because yes, the collapse of SVB is something that's taken a lot of the headlines over, but when it comes to inflation, there is some improvement, but prices, they're still up 6% from where they were a year ago. What was your big takeaway from this morning's report?
Yeah, definitely. I think we are still seeing a lot of stickiness to inflation here. Of course, the headline number, which includes everything, food, energy, shelter, goods, that was about as expected, a 0.4% month on month. But really, we're looking at, excluding some of these volatile components like food and energy. What did core CPI do? And that was a little bit stronger than consensus. That was a 0.5% month on month. And you're still seeing a lot of strength in components like shelter, which is expected to slow down, but really hasn't yet. You're still, I think, getting some further upside to goods prices. And then most importantly for the Fed, you're seeing a lot of inflation in these non-shelter services prices, things like recreation or personal services. And those are prices that are tied to a really tight labor market. And that's telling us, I think the Fed still has more to do here.
Yeah, you mentioned shelter, up 0.8%, double the CPI number, and 8.1% year over year. Let's step back a bit. And if you're Jerome Powell, do you actually see progress in this report?
Yeah, I mean, really not a lot of signs of that yet. I think a component like shelter, that's going to be sensitive to trends in the housing market. And we've heard Powell talk about how we're expecting shelter to come down. And that's true. We have seen home prices already slowing. We've seen new rents already slowing, but you're really not seeing it yet. And you're still seeing all the strength in all the other components. Through the second half of last year, we had some softer goods prices, but even those components are maybe starting to pick up again, not necessarily in this report, but we should have picking up, used car prices in the next couple months. And then those other services that are still very strong, not a lot of progress here.
So Veronica, you're making the case that the Fed still has more work to do. What do you think should be on the table in terms of a rate hike, the size of it, if you do think it's necessary at next week's meeting?
Yeah, so we're expecting a 25 basis point hike next week. Now back a week ago, we would have seen certainly risks of a 50. We even, temporarily changed our call to a 50. Of course, we've had a lot of financial stability concerns now, very volatile markets over the last week. So a 25, maybe seems, most likely, of course, for next week. But this is still, I think, a Fed that needs to raise rates more to weigh on inflation. I wouldn't rule out a 50, maybe not next week, but, especially as we're getting further, if some of this volatility has calmed down, we still think that policy rates are getting to 5.5 to 5.75. And some of those hikes, could be larger if this volatility dies down.
Of course, we're still continuing to digest everything that happened in the aftermath of Silicon Valley Bank. How do you think that factors in to where the Fed will or ought to go?
Yeah, it's certainly something they're going to be watching. Of course, any contagion risks, any impact on the broader economy that this might have, a tightening of credit conditions, less lending. That's certainly possible. I think it's really hard to know right now. We, of course, did have a really substantial policy response over the weekend from the FDIC and the Fed. And I think, for right now, at least, the Fed is probably looking at this and saying, well, we have some tools to deal with financial stability, and we've used those already. We still have a price problem. We still have an inflation problem. And we only have one tool to deal with that, and that's raising interest rates.
Veronica, do you see any, though, risk, the spillover effects to the U.S. economy when it comes to the fallout from SVB? Because, yes, we are seeing regional banks trend higher today, but so many of those names were hit pretty hard over the last couple of trading days.
Yeah, it's definitely possible, especially maybe some of these smaller banks that tightening their lending standards. I think for the most part, the contagion risk is lower than than maybe the market pricing is suggesting. We've had a pretty substantial moves over the last couple of days. I don't think it's so clear yet, how this will feed into the broader economy, especially because relative to what we would have thought 6 months ago, we're still running a really strong economy. We're still running 300K job growth. We're stronger than we would have thought. And maybe if there is some tightening of credit, lending standards because of this, then that maybe helps the Fed, tighten conditions a bit. They wouldn't want that to happen too quickly, of course. And that's the risk that we're watching out for. But for right now, this is still a really strong economy, just like what Powell was pointing to a week ago in testimony in Congress.
And Veronica, before we go, your terminal rate, what is it? And what's your base case on a recession?
Yeah, so we've got a terminal policy rate of 5.5 to 5.75 range, getting there by the July meeting in 25 basis point steps. We would still expect that by the second half of this year, we are slowing into a recession. That's still our base case. I think we would have expected to see more of that slowing at this point, and so maybe that recession is maybe more delayed. But if you're not getting the slowing in activity, you're not getting the loosening in the labor market, then there's not a lot of reason for inflation to come down, and that's a Fed that needs to be more aggressive, and then eventually, you would expect some kind of recession.
Indeed. Citi's Veronica Clark, thanks so much. Appreciate all that. All right, let's get up to speed now on the continuing drama surrounding banks following the collapse of Silicon Valley and Signature Banks. You can see bank stocks today skyrocketing. First Republic up over 30%, Western Alliance up almost 10%, and PacWest over 40% higher. Yahoo Finance's Jen Schomburger here with the very latest. Hi there, Jen. What are we hearing?
Hey there, Dave. Yeah, that's right. Regional bank stocks getting a bid today after the carnage Monday following emergency actions from regulators to shore up depositors of Silicon Valley Bank and try to stave off contagion across the financial system. Earlier this morning in an interview, I spoke with the top Democrat on the House Financial Services Committee, ranking member Maxine Waters, about what she thinks caused the failure of Silicon Valley Bank. She put the blame time squarely on a rollback and capital requirements and proposed that the committee will hold hearings soon to get to the bottom of this. Waters pointed to a 2018 law Congress and the Trump administration passed that loosened capital requirements and liquidity tests for smaller regional banks, including Silicon Valley Bank, subjecting them to less onerous oversight. Take a listen.
Flexibility was there and was given by this legislation to ensure that they didn't have to follow the rules of the bigger banks. And so some of them were trying to protect the regionals and smaller banks and saying that, we were crippling their ability to be successful with the rules that were too tough on these regional banks and smaller banks.
Waters pledged to hold hearings as soon as lawmakers can and understand not just what happened, but whether Silicon Valley Bank Chief Executive Greg Becker's stock sale, resulting in over $2 million in profits just weeks before SVB's failure, should be investigated. When asked whether executive compensation clawbacks should be on the table, Waters told me, quote, absolutely. Now, along with Silicon Valley Bank's failure, which resulted in market turmoil, Circle's stablecoin broke the buck briefly, and Waters has been working closely with House Financial Services Chair Patrick McHenry on legislation to regulate stablecoins. Waters told me that both sides have largely worked out their differences and that legislation could be passed within days when the House is back. Take a listen.
Actually, I believe the legislation could be passed when we get back to Congress in a few days. We had just about solved all of our problems.
Of course, while this legislation is just about ready to go, Waters added the caveat that there's always a bit of uncertainty around the actual timing, but that she and McHenry are very focused on this. Dave?
All right, good stuff there. Jen Schomburger, thanks so much. We are just getting started here on Yahoo Finance Live. Still coming up, we'll check in on South by Southwest, find out what's making the biggest headlines in Austin. And Mr. Wonderful Kevin O'Leary has a lot to say when it comes to the Silicon Valley Bank collapse and what went wrong. He'll tell us exactly what's on his mind. And Meta announcing it's laying off 10,000 more workers. Find out what it means for the company's bottom line. Don't go away.
South by Southwest is underway in Austin, Texas. Brad Smith, you're looking at a live view of him right now. He's in the middle of all that action. And Brad, you've had a jam-packed couple of days today, though. I know you took a look inside some of the technology that is being used right now in the medical space and spoke to some of those key players. What did you learn?
Yeah, it is jam-packed indeed, and we've been jamming on the one all day long here. We're outside right now of the historic Willie Nelson Boulevard right now, where you've got, of course, the man, the myth, the legend in monumental form behind me. And this festival is going to turn more musical over these next few days. But prior to that, it's been all business all the time, especially for one company in Johnson & Johnson, who's been presenting here at South by Southwest. You've got everyone from unicorn tech startups here all the way to the $400+ billion market cap companies that are showcasing their latest technology. And we had a chance to catch up with Sean Jigiswitharan, who is actually the global head of MedTech at J&J. And he walked us through some of the innovations, especially on the virtual reality front, that are going to be so key in improving the patient experience, from the way that doctors are trained all the way to how patients are educated on the type of surgery that may be the future of this medtech technology, and they certainly look to move forward with at J&J. And here is a little bit of what he had to say during our conversation.
I think in the short term, it accelerates and increases access and equity, which is two of the largest issues to solve for in healthcare. In the longer term, it's going to lead to things like automation, lead to things like robotics and automation together, and that's a game changer in the future. There's always that storyline on AI and digital replacing things. I think the storyline here is around augmentation. It improves efficiency, it improves precision. Think about, the simplest example I can think about is what a calculator has done for folks in stats, mathematicians, data scientists. It hasn't replaced anyone. It's made them better, enabled them with tools, and ultimately better outcomes for them.
And so if there's anything that I would draw a through line on, it's that augmentation word here particularly, and in all of the conversations that we've been having, from the likes of J&J and even to Grand Chess Master Gary Kasparov, also even into Shutterstock and their chief product officer. Everyone is saying that artificial intelligence should actually be reframed as augmented intelligence here. And in J&J's case, this could improve the patient experience all the way into some of the other applications that we've continued to discuss. In Shutterstock's case, that augmented intelligence is really what's going to create more of the skills that are necessary for the workforce to be able to work with some of the different language learning models that will help improve productivity. And so that's been the broader artificial intelligence conversation, but artificial intelligence is going to be so ingrained in robotics, in virtual reality, and all of those things driving some of the solutions that are being presented here at South by Southwest and could become a very real part of our lives within the next 2 to 3 years, some of them even quicker than that. And so all of that in mind, that's been kind of the common denominator in reframing the conversation around around artificial intelligence into augmented intelligence, so that even as we're training some of these models, we're ensuring that they're learning along with us about how to be more ethical about the technology in artificial intelligence as a whole.
And that'd be huge going forward. It's just amazing just how many industries, it seems like every single one that AI will touch, is already touching, and will potentially touch in the years to come. Brad Smith, great work down there. Looks like a beautiful day too. It's snowing here in New York City. I know.
What?
You need to share the sunshine with us.
It's been cold in the mornings, if that means anything.
All right, that makes us feel a little bit better about the snow that we're looking at outside the window. All right, Brad Smith, thanks so much. Coming up, it's been a wild ride for both banking and crypto investors in recent months. Shark Tank's Kevin O'Leary, he will tell us what to expect on both fronts when we come back. We've got about 40 minutes to go in the trading day, and you're looking at gains across the board. This is a market check sponsored by Tasty Trade. The Dow holding on to those gains, up just 62 points. The Nasdaq once again leading the way, up just over 1%. There is some, I guess, more positivity, more optimism, at least in the market today, after maybe the fallout from SVB won't be as bad as initially feared.
ABC's hit show Shark Tank describes itself as having reinvigorated entrepreneurship in America. Might the collapse of Silicon Valley Bank have the exact opposite effect, stifling innovation and tech startups at the same time? Kevin O'Leary, Mr. Wonderful, O'Leary Ventures chairman, joining us now to weigh in. Good to see you, sir. People always look to you for that no BS explanation of things out in the business world. How do you tell your neighbor or the guy at the bar what went wrong? What happened with SVB?
Very simple. Let me explain what happened last week. This is a combination, a powerful one, of idiot management with a board above them that was incompetent, or at least asleep at the wheel. Because what happened here was just plain bad management. To make the bets they made means they know nothing about banking. I hate to be so blunt, but that's a horrible combination. They blew themselves up the old-fashioned way. Idiots. That's the bottom line. And at the end of the day, they caused chaos in the banking system. And the outcomes now with new policy in place are not good. Because if you think about what's occurred here is we let one bank, and let's talk about the other option of letting that bank fail, okay? They blew themselves up, let them fail, what would happen? 95% of those assets, including the accounts that were not insured by the FDIC, that had more than 250,000, which was 90% of the accounts, were held by sophisticated investors, such as hedge funds and venture capital firms. They're big boys. They understand risk mitigation. And either they were or they weren't doing their jobs. They would have got back 95 cents on the dollar. And then for everybody that had 250,000 or less, they would have got all their money back. Now, the big discussion was, okay, has this breached confidence in the entire U.S. banking system? And I would have argued it would have been volatile for a few days, but this was not a 2008 Lehman Brothers situation. These are just idiot bankers with an incompetent board. It's that simple. Now, we should have let that wave go right through onto the beach and come back in. That would have been fine. But instead, we're sitting in a horrible moral place today where every single account in every single bank, regardless of who's running it, is guaranteed by the taxpayer. I'm not happy with the outcome.
So, Kevin, what do you think this then means for the banking sector going forward? Do you think we will see more risk from other banks, given the fact that regulators were so quick to step in and were so quick to guarantee all of those deposits?
Well, let's think about what's going to happen. I'm a banker. My primary compensation is equity in my bank. Now I've just been told that my deposits that I get to do anything I want with, which was what was going on at the Silicon Valley Bank, really stupid investments, but basically they took 90% of the depositors' money and bet it long on 10-year treasuries right when the Fed was raising rates. Yes, only an idiot banker would do that, but that's what they did. Massive risk. But now I can be running a bank and just spend all of my day worrying about the stock price because I don't have to worry about the deposits anymore. You and me, the taxpayer, basically, I have that risk now. I can do anything I want as a bank manager. I can swing for the fences. I have to stay within the rules of banking, but I can take inordinate risk to move that stock price and never worry about what I do with the depositor's money. Does that sound like a good idea to you?
Not my favorite. Your fellow shark, Mark Cuban, he had between $8 and $10 million invested in businesses there with SVB, and he tweeted this, quote, "The Fed should immediately buy all the securities and debt the bank owns at near par. The Fed knew this was a risk. They should own it." What do you think of his thoughts on this situation? Does he have it wrong?
Well, I think which Fed owns it? I think the San Francisco Fed owns it for not being an overseer to this board of directors who is obviously negligent. And we'll see that'll be tested in court. There's no question about it. I'm not sure Fed policy is to blame for what happened at SVB. I think it's just idiot management. And that's why it's okay to let a bank fail if it's run by idiots. I'm okay with that. And frankly, at the end of the day, I had all kinds of companies with money in there, including Circle, that had over $3 billion in there. But we would have got back 95 cents on the dollar anyways if the Fed hadn't rescued it. Now, this did cause some damage for USDC as a crypto. It broke a buck over the weekend. It went to 95 cents. And that's brain damage for the long term. But at the end of the day, we changed policy for the entire banking system without thinking about the unintended consequences. And it's really, really ugly. Now, that's changed policy for me as an operator with multiple platform companies. Here's our new mandate. Here's what we've decided to do given what's going on here. We've told our CEOs, do not put more than 20% of our liquid assets in any one institution. I don't care who you know or how big they are. There's always the next black swan idiot manager in big and small banks, and we don't know who they are. So I only want 20% in any one institution. Secondly, very few people know this, but the Fed has already allocated $250 billion plus to small businesses that did not take advantage of it in what's called the Employee Retention Credit Program instituted in 2020 and 2021. Every single one of my companies now applied for that. That is up to $26,000 per employee towards payroll. This whole narrative started last week around payroll, around the companies inside the Silicon Valley Bank not being able to pay payroll. And yet practically none of them had already got the relief the government offered them with the ERC program. And so I've made it a mission now to tell every small business that's sitting around wondering, can I make payroll now that money's gotten really tight in the venture community? Well, yes, you can by tapping into what's already been given to you in the ERC. And you can go get it. You just have to find out if you qualify. You need at least 5 employees, and then you can. But these are things that no one knew about. And now the government bailing out this small bank that blew itself up. No one ever heard of Silicon Valley Bank and general population. Now they own it. Now the taxpayers have the liability of every single account. I think this is really, really difficult policy, and it's going to have major political implications. You can see this being divided by party line pretty soon.
Kevin, when we talk about the impact that this is going to have on the startup community, clearly they have been in free fall over the last couple of days trying to figure out exactly what comes next. How big of a chilling effect do you see this having overall on the startup community? And I guess how big of a disadvantage maybe Silicon Valley will be positioned here against some of the competitors, specifically what we're seeing in terms of innovation overseas?
I think it is going to be very challenging. But remember, there was a time when we had rates of 6 or 7%, and the venture community did very, very well. I think what happens now is there's going to be curation of the quality of deals. So the speculative, really risky stuff that maybe you would have taken a flyer in the portfolio, you're not going to do now. You're going to go and be more concerned about the pathway to profitability than ever before. We're grooming our portfolio and deciding which we're going to support and which we're not, because already the capital started to dry up for them. Factoring, that's when you factor your receivables. 4 months ago was 9%. Today it's anywhere from 17.5% money, and I have a company recently that borrowed at 35% just to get cash. So things have gotten really, really tight. That's a combination of the Fed raising rates faster than they have in decades, but also the fact that this is a new environment where we saw what occurred with the loans that were sitting in Silicon Valley Bank that were basically, many of them were garbage. Up to 9% of them wouldn't qualify today for any bank loan. And so they were very, very loose. And they also had predatory marketing practices, which I think are going to be questioned by the regulator. For example, you raised $25 million with VCs. SVB said, you put that $25 million in here and you keep all of it here, and we'll give you a very loose loan. But then you've got to take that loan money, also keep it in the bank. And by the way, do you need a mortgage for your CFO, your CIO, and your CEO? We'll give you that too. I think all of that's going to be scrutinized as predatory marketing practices, because no company should keep all of their liquid assets in one financial institution. I think we've proven that over the weekend. That's a really stupid idea, because you don't know where the next black swan is swimming. It's in the lake somewhere. There's idiot managers everywhere. And lastly, what we've really said to ourselves as an economy, there's 11 sectors in the S&P 500. One of them, called financial services, is the only one that services all other 10 sectors. I think we just nationalized it. And so if you're going to become a shareholder in a bank, you should think twice. Also, you should think about whether you ever want to own bank bonds, because I think the profitability of this sector is going to be under tremendous pressure as the regulators make the margins much more liquid. That's less profitable for banks, and the cost of compliance much higher, which squeezes margins. I think the best days of banking from an equity point of view are behind us.
Well, hopefully the regulators ask some of the very questions that you just proposed. Finally, a lot of unintended consequences, needless to say here, many of which you've mentioned. One we didn't see coming was the wine industry. Apparently, SVP had lent out more than $4 billion to the wine industry over the last 30 years. You know a thing or two about wine. What do you expect the impact to be here?
Well, basically all the accounts have been guaranteed. So the panic that occurred in the wine industry on Friday, Saturday, and Sunday has been alleviated. But those loans that were provided for buying or renting acreage, they're gone. And so what the wine industry has to do is try and figure out what the varietal is that people want. And they've got to go get that juice at least 2 quarters ahead of time. Sometimes they buy land, sometimes they buy wineries, sometimes they lease land. All of that has to happen with debt. And so that was one of the banks that provided a lot of it. That's not going to be the case going forward. The wine industry is unique. It's been very, very, very successful in California. Some of the varietals we make, we're all proud of. But clearly our cost of capital, and I say this as a participant, is probably going to go up 30%. No question about it. It's going to make the larger operators probably more protected around a moat, and the smaller ones are going to be acquired by the larger ones. It's going to force consolidation in the wine industry. And I remind everybody that the wine industry, 97% of wine is sold for under $15 a bottle. So it's a very thin margin in the first place. You need major scale and logistics, and that lends itself to the larger players.
Wow, that's enormous impact. All right, next time, come in studio, we'll have a glass. We'll cheers to all of that. Kevin O'Leary, Mr. Wonderful, good to see you, sir. Appreciate that.
Take care, bye-bye.
All right, coming up, shares of GitLab are falling sharply. Find out why. New guidance from the company has investors concerned. Next.
It's time for a triple play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Schwab, GitLab, and United Airlines. Let's kick it off with Schwab. Deutsche Bank reiterating its buy rating on the stock, making the case that liquidity risks that had been hammering the stock over the last couple of trading days before today's relief rally that they have been a bit overdone. Now, this is one of the stocks that has been on quite a wild ride since the collapse of Silicon Valley Bank, as investors did worry that firms with large positions to bonds of longer maturities will be forced to sell at losses to cover deposit withdrawals. Now this week, Schwab CFO Peter Crawford, he looked to reduce some of those rising fears, writing in the company's monthly update that more of 80% of Schwab's total bank deposits fall within the FDIC insurance limits, very different than what we saw from SVB, and also that the company is, quote, well positioned to navigate the current environment. Now, while Deutsche Bank does have that buy rating on the stock, it did warn about a, quote, significant near-term EPS impact driven by the upcoming changes that they are seeing will likely to be made to Schwab's balance sheet, given that new environment that we are in right now. So, Josh, I think it's safe to say these regional banks far from out of the woods just yet, but a name like this here, Deutsche Bank, saying they do see the compelling reason to buy a name like Schwab today.
It's really the emphasis here needs to be on that they're all regional banks, but they're all still very different, right? And when we think about Schwab, like you said, Shauna, 80%, over 80% of their assets being FDIC insured, or their customer assets being FDIC insured. Then when you go to Silicon Valley Bank, and it was essentially the opposite. It's a very interesting number there. And then you got to look at the other hand of what Deutsche Bank is saying about the profitability, near-term concerns. Moody's out with a note today saying that they're worried about profitability sector-wide, Dave. So that's something that does maybe apply to all regional banks and maybe just banking in general right now. But then when you think about the bank specifically, still differences in sort of how these banks operate.
One guy instilling confidence in the company is Ron Barron, longtime investor, said he bought the dip, wouldn't disclose how many shares, but last owned 7.8 million as of December. So that ought to bring a little investor confidence back in the corner of Charles Schwab.
Schwab up today, but I'm taking a look at a company that's down pretty bad. GitLab, the company guiding for a wider than expected first quarter loss and lower revenue than Wall Street had been anticipating, sending shares down nearly 25% today. Now, GitLab is a software company whose clients are often other businesses, so the company's results sort of provide a peek into corporate spending trends. The company's CFO, Brian Robbins, noting on the earnings call, quote, "We saw that some of our customers experiences changes in their business, which led to either hiring slowdowns or a reduction in workforces." Robbins adding this negatively impacted expansion and upgrading from customers, while also highlighting GitLab's experienced great deal scrutiny at the end of 2022 as companies take a closer look at their spending. So sort of an interesting spin here, Dave, when you think about what's happening with Silicon Valley Bank and what's happening in the Valley as a whole. GitLab is the kind of company that benefits from growth stage companies that need software and need B2B service. And GitLab seeing a slowdown in spending from tech companies. Does that continue to play out moving forward? Dan Ives, who's coming on in the 4 p.m. hour, says yes. So interested to hear more from him then.
Yeah, definitely interested in Ives' thoughts on the impact on tech. Bank of America, for one, they reiterated their buy rating on GitLab's, though they did cut their price target rather dramatically from 75 to 50, but still confidence. They just think this is a longer play than they expected.
Yeah, exactly. And I think some of the recent selling that we have seen in GitLab, that has been maybe overdone. That, of course, has been the case that has been made at least from Truist. And then when it comes to another name here, Cowen, saying that they continue to have a strong competitive position when talking about GitLab and some of those price hikes that we've been talking about. Maybe that will be able to offset some of the growth that we're talking about that we could potentially see here sector-wide.
All right, finally, my play is United Airlines, a trending ticker on Yahoo Finance. United shares slumping on a pessimistic outlook for the current quarter. You can see shares off 6.5%. UAL expects an adjusted loss per share between 60 cents and $1 due to expenses related to this new collective bargaining agreement with employees that are represented by the Pilots Association. In a filing, United says they continue to see, quote, a strong demand environment and now expects first quarter 23 operating revenue up approximately 50% versus Q1 of 22. But they added that January and February were lower demand months. Increased fuel prices also weighed on cost there. Elsewhere in the sector, Southwest, Alaska, Spirit Airlines gave weak to lackluster guidance, while JetBlue said it continues to experience quote, robust travel demand trends. They were up solidly earlier in the day, have cut back down to earth. So a bit of a mixed look on an industry that has been on fire in recent months.
It has been on fire, and we had discussed many times that airlines continue to raise their fares, and it looked like consumers were willing to pay anything that was put forward in front of them. And when we got this latest revision here from United, from some of its peers out there in the industry, it looks like we may be seeing consumers pulling back just a little bit, or getting a little bit more cost conscious on what they are paying for fares, because it doesn't look like United, at least, is going to be able to be charging those same amounts here going forward.
Well, that was what stuck out to me, right, is it's the jet fuel. At some point, rising jet fuel prices, you can only cut costs so much, and really that does get passed on to the consumer. They had initially thought it was going to be $3.19. Look at that, updating the guidance to $3.31 to $3.41 per gallon of jet fuel. That's a pretty big bump there from what they were anticipating. So unfortunately, I don't know if that's going to mean cheaper tickets for us anytime soon, guys. I was hoping for it, but probably not.
I don't know. If demand continues to fall or pull back or not meet their expectations, we might be looking at lower prices sooner than we thought.
Tell you what, they got a mess on their hands with this storm hitting the East Coast. I have a flight delayed 2 hours. So
oh, no.
I think the whole coast is starting to see the impact of that one. Let's see how Southwest handles this one.
Oh, well, hopefully a lot better than they did at the end of December. All right, well, coming up ahead here, people have a lot of questions about how safe their money is after Silicon Valley Bank's collapse. Questions like, should you keep all of your money in one bank or spread it across a number of different accounts? We will have some answers for you when we come back.
We've talked an awful lot about the collapse of Silicon Valley Bank and the impact it could have on banking, regulation, and tech. But what lessons can you take away from this event so that you can better manage your money? Joining us now to answer some questions that you may have if you have over $250,000 in the bank, and God bless you, is Kenny Polcari, Case Capital Advisor Managing Partner. Not a problem I'm focused on at the moment, but hopefully someday, Kenny. It's aspirational. If you have $1 million cash, what you do with your money?
Listen, if you got $1 million in cash, you're going to do more than just let it sit in a checking account or sit in a savings account, right? So you're going to put it in the bank. You can do a couple of things with it. You can split it up amongst two banks, which I would say, as you start to get to that category, you should have a couple of banking relationships anyway. You shouldn't just be in one bank. Now, you can make one of them a money center bank. You can make one of them a more regional bank if it's convenient for you. But when you start to get up there, you should consider separating it. But one way or the other stuff you should do is if you need it in cash, take your limit, which is 250. Leave that in cash if you want. You should take the balance instead of letting it just sit there. Buy Treasury short term, 3 months, 6 months. This way, you're kind of liquid, right? You got a 3-month time frame, but you're completely protected because once you own Treasuries, you're no longer part of that. Even though there's $1 million, quote unquote, in the account, 750 of it is in U.S. Treasuries. Those aren't going anywhere. You're not losing your money there. You're gonna sell them when they come due. You mature them, they mature, and you get your money back.
So, Kenny, we're talking about 250,000 is the threshold here because it's up to that limit that the FDIC ensures those depositors. When you have over that amount, is there any reason that you should ever have all of your money in one bank? Should it always be in a number of banks?
Well, listen, I think diversity is a good thing, right? Diversifying is a good thing. So if you've got, 250,000, you want to have it in one bank, that's the limit. Although I would argue after last weekend, I think the sky's the limit, right? They protected everybody. They backstopped all the depositors. But let's stick with the 250 argument. So if you've got up to 250 in one bank, you're protected, doesn't make a difference, right? If you have much more than that, like I said, you should probably have a couple of relationships. You don't necessarily have to have, if you have $1 million, you don't necessarily have to have 4 different relationships and put 250 in every bank. You could have 2, one big money center bank. So by that, it's either a Chase or a Bank of America or a Wells Fargo or a Citibank, right? One of the big money center banks. And then if you want to put money in a local or a regional bank that's in your area, that for whatever reason you want to support that, you want to be part of that, you can certainly do that. But again, if you're worried about losing money, then keep the limit in cash if you need that much cash, and then take the balance and put it, like I said, either in Treasuries if you want short term, you want to be liquid, but you want to be invested, you want to be protected, you would do it in something like a 3-month or a 6-month bill. Otherwise, you put it in a CD.
Yeah, distrust is really growing in these regional banks, in particular yesterday when you saw all these shares plummeting. What's your sense? Should people stay away and stick with a Bank of America, a Wells Fargo, a Citi?
Listen, no, I think yesterday's action was way, way, way overdone. And it's obvious by what we see kind of happening today. A lot of these are bouncing back. There are some good names in there that got dragged down yesterday with all the drama that took place, last week and over the weekend and the concerns. And oh my God, listen, the Fed wants regional banks. The country needs these regional banks as well. And some of them are super regionals, and they're fine. And you shouldn't necessarily be, a bank like Silicon Valley Bank, which, by the way, didn't serve you and me, didn't serve most people in this country, probably never heard of it, right? It was a very specific bank serving that community. But if you go around the corner to a local bank or to a regional bank, you go to a Co-America or you go to a Cap One or you go to Regions Financial, there's nothing wrong with any of those banks. But if you're worried, then just keep the limit, right? And then take the balance of your money and put it in what I would do is a larger money center bank, or you're going to have it in a place like, a Fidelity or a Charles Schwab, where it's going to be invested either in stocks or in bonds, but a place that's going to be outside of the regional bank, for instance.
Kenny, when it comes to people managing their own money, I think people get overwhelmed very quickly. What's the one common mistake or one thing that people should always try to avoid when it comes to managing their money, obviously other than losing it all?
I think the common mistake is not being diversified enough, right? A lot of people what I find is a lot of people managing their money tend to overweight in the stuff that they like, which is great because there's something, that's the Peter Lynch kind of mentality, is that buy the stuff you know and buy the stuff you like because you know it, you like it, you use it, you understand it. But they tend to be too overweight sometimes in those sectors, and then they miss the opportunity. So, if you're going to do it by yourself, then take advantage. A lot of these places have all kinds of online videos and YouTubes and classes and information that are going to try to help you avoid that mistake, right? By being diversified and also rebalancing and understanding the power of dollar cost averaging and reinvesting your dividends and putting it right back into the names that you like.
For those people whose eyes are glazing over with that information, when you're looking for a financial advisor, how do you separate them, the good ones from the pack?
Well, listen, a lot of it is reputation. A lot of it is relationships. A lot of it is referral, right? Because sometimes you're not just going to pick up the phone necessarily and and just arbitrarily go Google financial planner and come up with the first name on the list and call that person. You're not going to come because somebody's going to refer you, or you're going to see this person in action. You're going to have heard them speaking at a conference. You like their style. You read their information. You get a sense of who they are. You get a sense of how they manage. And that starts the initial conversation, right? I'd be very surprised if people just arbitrarily pick up the phone and dial a number and say, hey, I need you to manage my money. There's got to be some homework that you do. Again, most of it is referral in this business, right? Clients I get come to me mostly from clients that I'm already servicing, people that are happy with what I do, how I provide, how I manage. And so that's how it really builds. But people should be very, very cautious, especially now in terms of how they really interview wealth managers. Because listen, you should interview a handful of them. You should have your list of questions lined up. Even if somebody refers you to me or to somebody else, you want to get to know me. So you want to have a list of questions, understand who I am, how I manage, how long I've been doing this, what my success rate is in the sense of, being in this business. For me, I'm in this business 42 years already, right? And I'm still sticking around, and I love every minute of it. And I think, those are just some of the things you got to be aware of.
All right, Kenny Volkeri, well, we hope to have you back here in Yahoo Finance Case Capital Advisor Managing Partner. Thanks so much.
Always a pleasure. Thanks for having me.
Well, rideshare companies Uber and Lyft getting a big win in the California Appeals Court Monday. They, along with the delivery apps like DoorDash and Seamless, can now treat their drivers as independent contractors. Here to tell us a little bit more about what that means for the gig economy is Yahoo Finance's Dan Halley. And Dan, certainly a huge victory here for some of those larger players.
That's right. Uber, Lyft, DoorDash, companies like that are basically getting a win here with the appeals court upholding Proposition 22. That allowed the companies to basically assign their employees, or rather drivers, as not employees, but as gig workers, contractors. And so they don't have to provide them with the kinds of benefits they would for full-time workers. Proposition 22 was originally considered unworkable by the Superior Court, but this appeals court panel of 3 judges went ahead and said, no, there are some provisions in it that we don't like, but by and large, this can stand. And so now going forward, it looks like Uber and Lyft, DoorDash, and the like, any kind of gig company can really classify their workers as gig workers, meaning that they don't have to pay out for things like medical care, full-time employment benefits like days off, and that doesn't mean this is the end of the story, though. This is likely to go to California's Supreme Court, where we'll see an alliance of different organizations on behalf of drivers really try to get this overturned and do away with Prop 22 in its entirety.
Uber investors certainly happy with that ruling. Meanwhile, Apple looking to trim some costs. What can you tell us there, Dan?
Yeah, it looks like they're freezing some hiring and then also cutting back, or at least rearranging the schedule by which they provide some bonuses and incentives along those lines. This is something, that Apple is doing in lieu of laying off employees. At least that's the way it looks for now. This is a company that, unlike the likes of Amazon, Google, Microsoft, Meta, hasn't had to do mass layoffs. There aren't thousands of workers out of jobs. So they're holding off on hiring. They're doing that freeze, and then those bonuses, basically ensuring that they have the cash on hand that they need. Apple, unlike its peers in the space, didn't staff up as heavily during the pandemic. All of those other companies seem to think that we were going to stay in the kind of pandemic lifestyle, glued to our chairs, not going outside, staying perpetually online. Look, we're still online a lot, but not nearly as much maybe as we were during the pandemic. Apple, they're a hardware company. They also sell services, but the other companies really focus on software, sales online, things like that. So that's where they went wrong. Apple seemingly made the right call. And so far, at least, they haven't had to do any layoffs.
All right, Dan Halley, great stuff. Thanks so much. We are counting down the final minutes of trading here, counting down the closing bell. Still looking at gains across the board. The Dow now up almost 300 points. We'll be right back.
All right, just a few minutes away from the closing bell. That's always time to bring in Yahoo Finance's Jared Blickery to break down the market action. What do we see, my friend?
We are seeing a rally on Wall Street here. Let's check out the Nasdaq. That is up the most, 2.07%, still off the highs from earlier in the day. But I think investors will take that given the drubbing that's been happening in the markets, and not the least of which is that hotter than expected services print on the inflation front this morning. Anyway, Alphabet up 3%, NVIDIA and Tesla up over 4%, Meta up over 7%, best day in quite a while here. Also seeing some strength in the chip stocks as well as software. So really the tech trade doing well today. Let's check out some of the leaders, and indeed communication services and tech. XLC, XLK, those are the two biggest winners, each up over 2%. So are financials. Consumer discretionary, the other mega cap sector, that's also outperforming the S&P 500 here. Staples, that is taking up the downside, but still up more than 0.9%. Now I want to get into some fringe money here. This is the AMC trade, common shares versus preferred, and we have the preferred, the APE shares up here. They have now sunk into the red today for 5%. We did have that shareholder vote that went on. Shareholders approved the 10-for-1 reverse split, as well as the increase in authorization and shares. So you would expect to see some normalization here. And indeed, if we go to a year-to-date chart, we see AMC up 14%, AMC APE 16%.
All right, well, that wraps up the trading day. Here you're looking at gains across the board, adding to the gains in the final hour of trading. The Dow up just over 300 points, S&P up just over 1.5%. The Nasdaq, the outperformer once again today, up just over 2%. Well, despite the gains on the board here, it was some concerning developments that you could see play out throughout the trading day. And the first one there was Moody's changing its rating on the U.S. financial system, lowering its outlook, I should say, to negative from stable. Yahoo Finance executive editor Brian Sozzi is here to break down this huge headline for us. And Brian, when we take into account what we just heard from Moody's, I guess first just talk to us about the significance of this.
Yeah, it's giving me vibes back to covering that 2008-2009 crisis, and then ultimately, of course, when the U.S. credit rating got downgraded, I believe, in 2011. My first thought when I saw this was the cost of credit is going up, and it's not just going up likely for banks. It could go up for many households. If you want to go out and buy a pair of jeans on a credit card, your cost of credit may go up, in large part because you see Moody's here lowering their outlook on banks. Now, the significance is essentially this. Moody's is essentially saying this SVB situation and Signature Bank will have adverse effects on funding, liquidity, earnings, and capital. Another way of looking at that is Moody's has less confidence in the earnings potential and the returns potential for the banks. And when that happens, what are banks likely to do? Raise their own prices for their various services so they can help fund their business. They pass those costs on to consumers, essentially us.
Fair. Are any of these banks of similar profile, though, to SVB in a high number of uninsured deposits?
Oh, I sure hope not, because my money's in Bank of America, Dave. All right, and that right. That is part of the list here that Moody's highlights. They're looking at the entire banking system. First name of bank on here is Bank of New York Mellon. You have J.P. Morgan. You have Bank of America. Now, of course, those companies, you look at J.P. Morgan, they're known as having a fortress balance sheet. Of course, they're not in the same boat as SVB, but still, Moody's is making a broad brush statement saying, as a result of the situation, it'll have ripple effects, and the earnings for all the banks, even if you're healthy, will likely be impacted this year.
Certainly some concerning developments there, and something that we need to keep an eye on. Brian Sozzi, great stuff. Thanks so much.
All right, shares of several regional banks did bounce back today. In particular, First Republic up nearly 30%, but still down more than 60% over these last 5 very tumultuous days. For more on the sector and the impact of the SVB crash, we're joined by Morningstar equity analyst Eric Compton. Eric, good to see you. How does Moody's slapping a downgrade watch on 6 U.S. banks impact your expectations?
Yeah, so I mean, we broadly agree with the sentiment expressed by Moody's, where in our own forecast, we are going to be acknowledging some of these, for example, increased funding pressures. I think they're absolutely right about that. There's going to be increased competition for deposits. Banks are going to want to shore up the funding side of the balance sheet, and so that's going to hit. It's going to hit net interest income. It's going to hit bank profitability. You could see things like increased regulation in the future, which would also likely be a drag on profitability. So broadly agree with the sentiment there that bank profitability is going to be pressured over the next several quarters for sure.
Just want to follow up on you actually think there's a path to increased regulation, as in getting legislation through a Republican-led House?
I mean, legislation or increased regulation could happen through several avenues, and it could take more than the next 6 months or a year. So I just think over the longer term, regulators do not look good right now, and they're going to want to change things to ensure something like this doesn't happen. And some of those changes you could see come from the Fed, come from the FDIC, increased regulatory capital requirements, changing how regulatory capital is defined, things like that. So, nothing for sure there, but when a blow up like this tends to happen, you tend to see more stringent regulation in the future.
Eric, put this in perspective for us. When you look at the collapse of SVB, comparing SVB to some of the banks that are in your coverage list, and some of those names have been hit hard over the last couple of days. Comerica, First Republic, Zions, they all initially took those hits. How did they stack up when you compare them to SVB?
Yeah, it's a great question, and one that we're getting a lot is how unique is SVB? And the answer to that is SVB was very unique. When you look at, for example, the unrealized losses on their securities book compared to total capital, equity was a 0 at that point. And then it was just a question of, are they going to have to realize those losses? No other bank under my coverage comes anywhere close to that amount of duration risk or unrealized loss risk. So SVB was unique in that regard. Some of the metrics you all highlighted before about just deposit flight risk, uninsured risk, SVB was also fairly unique in those regards, and all the banks under my coverage score better on those screens. And so on the one hand, SVB was a unique situation, and maybe all the regionals under my coverage survive from here. I don't think there's a reason why any of them have to be the next one taken over. However, the big unknown is, does this create enough fear where you create enough deposit flight from one of these institutions where it potentially puts it into stress? So all the banks under my coverage, very different from SVB. However, no bank is completely immune to a bank run if it is large enough, is the unfortunate reality.
Of course, the biggest banks, the biggest difference in that regard, you still have some buy on some of those. Who and why?
Yeah, so we think that while acknowledging the high level of uncertainty right now, the market is pricing a lot of these banks as if they are going to be, they're trying to discount who the survivors are and who aren't. And so these banks, especially a lot of these smaller regionals, if they survive, these distressed prices will likely go up. And so under my coverage, some of the names that have sold off quite a bit, looking at like a Comerica, for example, if they can keep that deposit base intact, today's prices just aren't going to make a whole lot of sense. Zions is another one that kind of comes up where they did not take much risk on the security side of the balance sheet. The losses compared to capital are not that high. The big question is, and no one knows for sure how deposits are going to shake out, but if they can keep that deposit base intact, today's prices are going to look pretty good, I think, 2-3 years from now. So those are some of the names I would highlight. Truist is another one where they have the benefit of being one of the larger regionals. And so I think maybe more incrementally likely to maybe see some of those deposit inflows. And they've also sold off pretty hard. A little bit more unrealized losses for them. But in the end, I think they make it. And if they do, today's prices, I think, will be a bit higher 2-3 years from now once this initial shock kind of plays out.
And Eric, though, talking about the short term here, the current environment, how much tougher does this make it to gauge or predict deposit flows, to predict funding costs? Does that make it exponentially more challenging for you as an analyst?
100%. The difficulty of the job being a bank analyst has gone up a lot over the last couple of days. And at the end of the day, it's I just have to admit, and I think anyone who's being honest has to admit, no one knows for sure what deposit bases are going to look like in next quarter's results. And that's the big uncertainty we're dealing with. And you can try to put guardrails around it, predict who's better or worse positioned. But at the end of the day, it is going to be very hard to predict what deposit bases look like in the near term.
All right, Eric Compton, Morningstar, thanks so much. Always great to have you here. Well, coming up, we've been talking about it. The regional banks, First Republic, Western Alliance, and Comerica shares each falling by more than 30% in the past 5 days. Following the collapse of SVB and Signature Bank, many are wondering if another bank is next. We'll discuss when we come back. Regional bank shares did post gains today. Some of those regional banks, after the collapse of Silicon Valley Bank, sent shockwaves throughout the financial system. Also initially put a tremendous amount of pressure on the bank stocks that you are looking at right now earlier this week and the end of last week. Well, Signature Bank followed suit after the collapse of Silicon Valley Bank. Now, many are wondering if more failures are to come. So what is that potentially going to look like? What does it mean here for the Fed's fight against inflation? For more on that, to answer those questions, we want to bring in Financial Times U.S. financial commentator Robert Armstrong. Robert, it's great to see you here. And I know you recently wrote for the Financial Times an article there asking that exact same question. Is another bank at risk? What do you think?
I think your previous guest, the Morningstar analyst, put it quite well. Another bank doesn't have to be at risk here. If you look at even at the stocks, the bank stocks that have been under the most pressure, their balance sheets and their risk management look very different from what we saw from Silicon Valley. The problem is that at moments of stress, rationality doesn't always predominate. This is a classic case of all we have to fear is fear itself. If people are jumpy and they do a run on a bank withdrawing deposits, anything can happen, which is, of course, what the authorities tried to prevent by announcing that unsecured depositors in Silicon Valley Bank would be protected and that there would be a liquidity facility for other regional banks. We just have to wait and see if that works.
So where we stand right now, Robert, would you say these banks, let's call it the most middle of the road, the regional banks will still exist, but on a smaller, just a smaller basis, or do you have a few that may not survive?
Oh, I don't think there are any that have an obvious existential threat right now. Again, on the basis of their financials. They look, even the ones that are under pressure look solvent. You know, the list that you're showing right now is a perfect example of that group. Those are good banks. I think the more interesting question is over the long term, over the short term, do we get a panic that takes a solvent bank down? That's a possibility, but unfortunately, it's impossible to predict. Over the long term, the question is, what is the place of the regional bank in the American banking system and in the American economy? Because the stresses of this week show us that the system is not, as it were, perfectly tuned.
Well, the stresses of this week, Robert, also brings into question the Fed, how the Fed is looking at all this, if this does actually pose a risk, if this is going to impact Fed policy here at the next meeting. What do you think?
It will impact Fed policy, and I should say that this is a very historically normal phenomenon. At the end of central bank rate increase cycles, funny stuff happens. Things break. And when things break, that spooks people. And when people are spooked, the economy slows down. So what we are seeing, this time it happens to be Silicon Valley Bank. 30, 40 years ago, it might have been the S&L crisis or, et cetera, Asian financial crisis. When the Fed tightens, stuff happens. That leads to a slowing of the economy. So the Fed has to be aware of this phenomenon. But they're in a very, very tricky situation. They have this reality on the one hand, that there is stress in the financial system, and there will continue to be stress in the financial system. And as we saw from the CPI, most recent CPI print, inflation is still too hot. So they can't simply pause, but this has to be part of their deliberative process in the months to come.
And finally, even if all these banks remain solvent, which we do indeed hope, what's the impact for everyday Americans on the lending environment out there, at least in the short term?
Well, if banks have to be more conservative to protect their balance sheets in an unstable environment, that means they're going to be more careful about lending. So that you're going to see, as you always do at this point in the rate hiking cycle, when stress starts to rise, what you're going to see is it's going to be harder to get approval for a mortgage, a car loan, a credit card, et cetera, because banks are not going to want the risk.
All right, Robert Armstrong, got to leave it there. Financial Times, really appreciate the conversation, sir. Thanks so much. Coming up, Meta is laying off 10,000 more employees, but our next guest doesn't feel this will hurt the company's growth trajectory. Find out why next. Let's do a quick check of the markets, sponsored by Tasty Trade, as the markets continue to digest the CPI number, up 0.4% month over month and 6% year over year. You can see the Dow snapping a 5-day losing streak, solid day up more than 1%, while the S&P gains 1.6%. And look at the Nasdaq leading the way on the day, 240-point gain. Again, that brought to you by Tasty Trade. Meta seeing its highest close in 9 months after CEO Mark Zuckerberg announced yet another round of layoffs. Zuckerberg telling employees the company is looking to reduce costs and flatten its organizational structure. As a result, the company expects to reduce, quote, our team size by around 10,000 people and to close around 5,000 additional open roles we haven't yet hired. Joining us now is Brent Thill, a senior analyst at Jefferies. Brent, always good to see you, my friend. So what's the impact on growth for Meta?
Well, the expense structure was way ahead of the revenue growth. So I think what we're doing now is bringing the expense structure down to where growth is at. And so, they've cut effectively almost $10 billion of expense out, which just tells you, how overweight they were on potentially unnecessary roles. So we now have over 20,000 job cuts. This follows a number of other tech companies. We've said this repeatedly, tech is overhired. There's a lot more cuts to come. This is not the last cut. Salesforce is cutting, Microsoft's cutting, everyone else in the industry is cutting. So it's matching what the rest of the industry is doing. It's matching to get back to where the revenue growth is. And effectively, it may be a sign too that the overall advertising market continues to be weak here in the front half of the year, which we've heard as companies are pulling back discretionary ad spend in a tougher economic tape. So at the bottom line, you're talking about a company that's still going to generate, over $12 of earnings power next year. You don't have to put a big multiple on it to get more upside in Meta stock, even though the stock is up 61% year to date.
Yeah, Brent, what do you make of the stock moves year to date up over 60%? Is a lot of that just driven on hope? Is it all driven on the efficiency line that we heard time and time again from Zuckerberg on that last earnings call? Or does a move like this make sense to you?
The move makes sense. I mean, the multiple got overwhacked. Multiple got overwhacked for a number of tech companies. So I think ultimately, when they gave the initial guidance and the stock literally torpedoed down on that guide last fall, they quickly did a reversal, of course. And I think it tells you that Zuck is in tune with what Wall Street wants. He's listening. He didn't do what he just wanted to do. He did what the right thing to do was. So I think ultimately that these cuts are important. They obviously are tough to get through, but I've said this repeatedly, technology is not a good hockey player. They are not skating to where the puck is. They are skating behind the puck. And if anyone's played hockey, it's a hard thing to do to catch up. And so they're really getting ahead of this now. I think it's a good thing. I think ultimately, again, in advertising, you don't have what's called deferred revenue like you have in software. You have no visibility. And so perhaps what can happen is maybe they went through this first quarter and they saw, a lot of advertisers turning down. So that's another concern that we have, that perhaps just the overall demand environment for advertising is effectively falling, throughout Q1. So that could be another explanation. I think the bigger one is just revenue growth and expense growth were completely misaligned. Yeah. This now puts them on the right path, and they've done a fantastic job. They've done a better job than most, when everyone thought Zuck was just going to go spend on the metaverse, and clearly, they're pulling off that message a little bit here.
Well, that's what I want to ask you about. I can't help but think, what were these 10,000 people doing if it has no impact on their growth trajectory? But as to your point about the metaverse, what does this tell you about a possible shift away from the metaverse and towards what?
AI. It's all towards AI. Our sources have said that on the inside that they're basically making a message towards artificial intelligence and a little less towards the metaverse. Now, there was a commercial last night that showed a woolly mammoth with your headset on TV during the Warriors game. And so you think about, they're still pushing the metaverse. They're not going to go away. They're not going to pull back from the opportunity here. I think they just don't have to push as hard. And I think they have to push a little harder around AI. And that is what they said, back in the fall. They were spending so much in CapEx. They were building out these new data centers with these new AI clusters. And I think when you think about kind of what's happening, that tone's resonating with Wall Street right now, which is their core advertising opportunity is the biggest opportunity. You make the AI better to see what you care about, and effectively then you can convert those customers into subscribers of different products, sell different pieces of commerce, different products via commerce. There's a whole opportunity that comes available. Again, I'm not sure that my kids' grandparents are going to be putting the metaverse lens on, or we're going to be putting it on in the short term. So I think it is exciting. It's a long-term opportunity, but I think it's the right one that they're pulling back the throttle on Meta. They're pushing forward the throttle in AI, and again pulling back overall expenses. This is resonating well. The one piece of this puzzle, I'll be very clear, we don't know, is like what's going to happen on the revenue side, and that's to me still a little bit of the scare factor that you have to be worried about in the short term on the stock.
And Brendan, it's been a pretty busy couple of days within the tech world with the collapse of SVB. A lot of people asking what exactly this means for the tech industry at large. How are you viewing this as an analyst? And I know you cover most of the larger companies within this space, but how big of a threat maybe do you see it being in terms of M&A or anything like that down the road?
I mean, there's wonderful people there, and I feel terrible for what happened. But I'd say that ultimately this has an impact on smaller private emerging companies. Most of our companies didn't have big exposure to SVB. Certainly, I think when you think about investments are still going to happen in the venture world, lending is going to get done, but perhaps there's going to be a greater scrutiny on the risk curve here. So, instead of taking 10 shots on goal, maybe we're taking 5 shots. And so I think ultimately for the private world, it's going to have a bigger impact. I still think valuations are coming down in the private world. They haven't matched the public world. We hear this from IXIC. We're more interested in buying public than private. We hear it from even venture capitalists we work with. The private markets is rational. The public world's rational. The private world is not rational yet. So I think this is only going to accelerate the pace of overall multiple compression in privates where it needs to be. That's a good thing. It's not a good thing to have a bank fail, but it's a good thing to have some expectation reset. And I think this is only going to accelerate that reset. I expect M&A to pick up. I expect venture capitalists to be a little more conservative and probably have a slightly higher level of due diligence before they make the move. So I think everyone's just a little more hypersensitive around the risk factors, which is a good thing. Ultimately, again, not been a great thing short term for the industry.
All right, Brent Thill, always great to get your perspective here at Yahoo Finance. Look forward to talking with you very soon. Well, coming up, could Silicon Valley Bank CEO Greg Becker, could he have done something to stop the bleeding that led to SVB's collapse? We will break all of that down for you. And one analyst saying that there's some public tech companies that could face some new challenges due to that collapse. Stick around, we've got the details for you.
The Justice Department has opened an investigation into the collapse of Silicon Valley Bank. That news comes just a day after President Biden insisted that those responsible will be held accountable and that, quote, no one is above the law. Liz Lopatto is a senior writer at The Verge. She's been covering this story there. Nice to see you, Liz. As of now, no implication that any laws were broken. But what can you tell us about those in charge, including CEO Greg Becker, and all of their responsibility here?
Well, thank you for having me. I think there are a lot of questions about how this went wrong. And I think one of the things that people noticed right away was that senior leadership had recently sold shares in the bank. And presumably they knew what their own balance sheet looked like. And they also knew that the Fed was going to be hiking rates. I think there are some questions around risk management here. I think there are some questions about whether the proposed share sale last week was the right thing to do. And so I don't know that necessarily anybody did anything wrong, but I imagine, given how enormously embarrassing this failure has been, there are going to be a lot of people trying to figure out how it happened.
Yeah, of course, given that no CEOs went to jail as a result of the 2008 financial crisis, still a hard to believe fact. What's your expectation that anything could come of this?
I don't know. I mean, one of the things that I think is true is that the underappreciated risk here is that startup land is very gossipy and the majority of your customers are interconnected. And so I think probably what happened had a lot to do with that kind of risk and a lot less to do with risks around, share sales, risks around whether it was the right time to raise money instead of trying to get debt. But I imagine that, everybody's going to be looking into this. Even the Fed is looking at whether what they did was appropriate. Hi, Jeeves. This is my cat. She has some thoughts.
Hello, Jeeves. Nice to see the cameo from Jeeves. While you corral the cat, let me ask you about California Congressman Maxine Waters, chair of the House Financial Services Committee. She spoke to Yahoo Finance earlier about some of those the share sales we've just referenced. Here's what she told us.
The rumors that are circulating about the stock sale, we're certainly going to take a close look at. It may need to be investigated. And I also understand that there were bonuses that may have been given out early. I don't know that to be fact at this point, but we're going to hold hearings as soon as we possibly can and unravel a lot of what we understand happened.
So whether it's you or Jeeves that handles this question, you make that call. Is it Congress? Is it the DOJ? Is it the SEC? Where does the responsibility in figuring this out lie?
I think everybody is going to want a piece of this. Certainly the SEC is involved, the DOJ is involved, the Fed is involved, and I suspect a lot of Congress is going to be looking to make, at minimum, some good news bites on hearings here. So I think stay tuned because we're still very much in the early days of how this plays out.
And lastly, what about the impact on the tech startup, biotech startup community and innovation as we move forward?
Well, that's a great question. I think we're going to see some changes. I mean, it sounds like right now everybody's getting their deposits, which is good. There are some questions about what's going on with debt. I think there are a lot of companies that are fleeing to much bigger banks, and there are some questions about whether those bigger banks really are going to be able to offer the same kind of products and services that Silicon Valley Bank did, partially because they may not understand risk models as well. So I think, again, we're in the early days of figuring out how this all shakes out, who the beneficiaries of this might be and what could happen. But I do know that there are certainly people in the Valley who are concerned that there might be more layoffs and other sort of fire sales on startups as a consequence of these actions.
All right, Liz Lopato, thanks so much for joining us there. Well, almost half of all venture-backed technology and healthcare companies did business with Silicon Valley Bank in 2022, and its collapse could send ripple effects across the industry. Here to talk a little bit more about that, let's bring in Dan Ives. He's Wedbush Managing Director and Senior Equity Analyst here. Dan, it's great to have you. So let's talk about those ripple effects here, because in your recent note, you call it SVB the, quote, godfather, bedrock of Silicon Valley. What's the impact then? It must be large.
I think it's significant in terms of the ripple effect, because this is really going to constrain financial conditions within startups, even on some of the late stage. And no longer with SVB, with this black eye collapse, I believe it's going to accelerate M&A, and it's going to have clear winners and losers. I think big tech's probably a winner in terms of from an M&A perspective, but clearly there's some darker days ahead with the daddy warbucks of Silicon Valley banking gone.
What about some of the losers, Dan?
Well, I think losers are clearly on the startup side. Some of those that, high cash burn, can't get funding from some of these other banks. I think when you look at ones that are heavily exposed on the tech side, I mean, you look at some of these names like a Twilio, a Hubs, you look at GitLab, what happened last night, Atlassian. I think that's sort of the next potential shoe to drop in terms of end market. Those focus on the tech community. And I think that's what investors are now trying to figure out in terms of, the ripple effects here. And I believe for years to come, this is going to be something that will impact the 408 area code.
Wow, for years to come. Dan, let's talk about how this could also impact M&A when so many of these companies struggling to get financing, struggling here in terms of how they are going to grow. Is this going to increase M&A, and by how much?
We believe it's going to increase M&A at least by 20%. I mean, I think even you're starting to see some funding, changes in terms of, I think there's some companies that might just rip the Band-Aid off, go down the IPO route, and even take valuation haircuts. But I believe big tech, they're sort of right now sharpening their pencils, because there's a lot of companies that if you can't get those lines of credit from an SVB, you're going to have much more scrutiny in just this environment that we're seeing. I think it's going to be a bonanza of M&A that ultimately comes out of this over the next 6-12 months in tech.
And you mentioned IPOs briefly, but really was on fire in 21, almost dried up entirely in 22. What's the impact in 23 as we move forward in terms of the IPO market?
I think you're going to need, obviously the first that needs to come out, and you'll see some valuation haircuts and nervousness. But I do believe, especially with the Fed right now, basically handcuffed in terms of, let's call it 25 bips, and they're going to have to pause, just given SVB and what we're seeing on the banking side. You'll start to see what I believe on tech and some of these other verticals. You start to see some of the, probably the best of the best come out from an IPO perspective, because funding, that's the key, right? And I think you're starting to see changes in funding, which I think is going to catalyze some to go down that route.
Dan, when we talk about some of the uncertainty out there within tech, I think a lot of investors are looking at tech, trying to figure out those winners and losers. I know you mentioned some of those losers. Outside, though, of that very specific space, should we be at all worried about some of these social media players, some of the other larger names within the industry, or no?
Look, I think some of the digital advertising headwinds are starting to abate. You see Zuckerberg finally reading the room, continuing to cut costs. It's 180-degree sort of change there. And I think as he's cut costs, all of a sudden you're starting to see these stocks move significantly higher, because investors like what they see. That's ultimately what creates the next cycle. I think valuations are reflecting a lot of bad news, and I think there's going to be a clear sort of winners and losers playing out. But so far, if you look at this, tech's held up a lot better than anyone expected. SVB specifically is going to hurt more the startups and some of the end users, toward tech. But I think that's what really starting to play out here in terms of this Game of Thrones.
Clear winners and losers among your March Madness teams as well, Dan. North Carolina fails to make the tournament from #1 in the country, but Penn State, a solid 7 seed, winner or loser getting that 10 draw against Texas A&M.
Look, I think, A&M probably should have been a 5 seed in my opinion, but I do believe Penn State ultimately wins that game Thursday night at 10 o'clock. And then versus that Longhorns. I think it's going to be tough, but ultimately in the Sweet 16. That's my big upside. Do you believe Penn State goes there? Like UCLA, and of course, I like my boy Edie on Purdue to go far.
Oh, the Big Ten. They have a 23-year title drought. Be interested to see if Penn State can hold on to Coach Shrews, though. A lot of teams going to come calling.
Oh, I think we'll hold on to him.
I think you're right. I think they need to pay that man. Dan Ives, Wedbush, good to see you, sir.
Thank you.
Coming up, President Biden and D.C. lawmakers are searching for answers when it comes to a plan for Social Security. Find out how much work they still need to do. Next. Social Security is one of America's hot button political issues, and we're going to attempt to break it down and what it is and why it matters to you. Social Security in the U.S. works like this. When you work, you pay your taxes into Social Security. The Social Security Administration, or SSA, uses your tax money to pay out benefits to four groups of people who have already retired. People without qualifying disabilities, survivors of workers who died, and lastly, dependents of beneficiaries. Your money goes to pay for people who are getting benefits right now.
All right, well, Social Security taxes are paid out based on your earnings up to a certain amount, which in 2023 is a little over $160,000. Now, if you do make that dollar amount, the maximum amount of taxes that you will have withheld on your paycheck this year is a little under $10,000. That's your earnings multiplied by the Social Security tax, which sits at around 6.2%. If you earn over that $162,000 here, you will not pay any more Social Security taxes. Eventually, when it is time for you to claim your benefits, you will receive money from the taxes younger workers are then paying. When in the U.S., you can start claiming your Social Security benefits at the age of 62. However, your full retirement age may be age 66 or older, and waiting to claim benefits until a later age, well, that means that you receive more money. Social Security can be difficult to discuss because it does have a financing problem, and the solutions, they do not please everybody.
Nope. Social Security's cash reserves will be depleted by 2034, according to the latest annual report from the Social Security Board of Trustees. If policy doesn't change, annual taxes may only cover about 78% of benefits every year after 2034. Now, lawmakers are scrambling for a solution. For more on this, we're joined by Bob Powell, Finstream.tv and co-founder, and Michael Finca, the American College of Financial Services professor. How'd we do, guys? Did we do all right?
That was fan A+.
There we go. We're starting it on a good note.
We're done. All right, we're out of here.
I'll defer to the professor, though.
Okay, Bob.
I'm very impressed.
We'll start with you, Bob. How dire is the situation at the moment when it comes to our Social Security?
Well, it's not urgent that we act now, but I think it's urgent that we start debating the possible solutions now, because 10 years will come rather quickly, and if we don't come up with a solution, then it will become very dire. But I think the problem right now is that for most lawmakers, this is an issue that they don't want to touch because none of the solutions are great, right? They're either cutting benefits or increasing taxes or a combination thereof.
Well, Michael, before we get into these possible solutions and some of the politics at play here, how is this going to affect how long we work, and especially for younger Americans right now when they're looking at their parents? Is it pretty much a guarantee that the younger generations are going to be working longer than the older generations right now?
Well, I would say it's pretty much a guarantee. And I would also say that they should, and that that's fair. So we have gained in the United States about a year every decade in longevity after the age of 65. What that means is that younger people today can expect to live longer in retirement. They're going to receive more years of Social Security income benefits. For them, it does make sense that our retirement age should be extended as longevity increases over time. That is fair. It may not seem fair because other people can retire when they're younger who are older than, say, millennials are right now, but it is fair in terms of equalizing the amount of time that we can expect to spend in retirement.
I think, frankly, we've learned that working a lot later is actually good for you and good for the ticker, but that's for a whole nother subject. Bob, the politics of this are they're complicated because nobody wants to touch it. And we got a reminder at the State of the Union just how hot a potato this is when it was addressed by President Biden. Let's listen to that interaction.
Instead of making the wealthy pay their fair share, some Republicans want Medicare and Social Security to sunset. I'm not saying it's a majority. Let me give you, anybody who doubts it, contact my office. So folks, as we all apparently agree, Social Security and Medicare is off the books now, right? They're not to be funded. All right.
Not entirely clear if President Biden had that planned out that well. It was a masterstroke in the end. But Bob, what does that tell you about the politics of the moment regarding Social Security?
The politics of the moment is that it's an untouchable subject. It's a third rail subject. And so I think both Democrats and Republicans aren't necessarily going to propose anything going forward. But I think there has to be some will, some desire on the part and it has to be, I think, bipartisan. And much like we did back in the early 1980s, we have to come up with a solution that maybe affects people down the road in terms of decades from now. And I think that will be a reasonable thing to start doing now, is to say, how do we protect Social Security benefits for the people who need it most? And the people who need it most are, at the moment, largely those in the lowest income quintiles. And the people that maybe need it the least are those in the highest income quintiles. So perhaps there's a way to, again, increase taxes in some way and reduce benefits in another, or a combination thereof, that would allow us to make Social Security what it was intended to be, which is a safety net and a social insurance program.
Michael, what about you when it comes to the politics of this? Clearly a very divisive issue, especially inside the Beltway. What do you think needs to happen or is necessary at this point in order for us to make sure that Social Security is still something that's going to be here and at 100% in 30, 40 years from now?
Well, I agree with Bob that it has to be a bipartisan solution. And actually, I am reassured that there are some political candidates now that are saying some things that maybe a few years ago seemed like no politician would ever say, which is acknowledging the reality that we may have to extend the full retirement age to make Social Security more solvent. I think some of the language is still incorrect. People are still saying things like Social Security is going to go bankrupt. People are not going to get their benefits. Well, they are. It's just they're going to get reduced benefits. So let's talk about how we make these trade-offs between taxing people more and decreasing people's benefits, because that's what it means when we increase the retirement age. It means that we're decreasing people's benefits. It's just another way to do it. But as Bob said, there is going to have to be some combination of increased taxes or reduced benefits to give the American people what has been promised to them. And to the extent that we can start moving forward quickly, the pain is actually going to be less if we can solve this in the next couple of years or come up with some kind of a solution, as opposed to waiting until we're on the precipice of that 20% cut, because nobody wants to see that. Nobody's going to get reelected if Social Security gets cut by 20% or more.
All right, well, Michael and Bob, we want to do something a little bit different here. We're going to play a game, and it's called Myth or Matter of Fact. And we bring this up because there's a lot out there that's misunderstood when it comes to Social Security. So we're going to give you guys a statement on Social Security. You have 20 seconds to reveal whether or not it's a myth or if it's a fact and why. So, Bob, we're going to start with you. Then Michael will ask you another question here. But, Bob, myth or fact, Social Security will go broke soon?
Well, Michael just sort of hinted at it a second ago. The trust fund will have a deficit come 2034, and beneficiaries at that point will receive 77% of their scheduled benefits. So it's a myth that it's going broke, but it's a fact that there will be a shortfall.
Okay, Michael, myth or fact, Social Security benefits keep up with inflation?
Well, that is a little bit of both. So they do keep up with inflation in the sense that there is an inflation adjustment to Social Security, but it's been argued that that inflation adjustment is maybe a little bit too generous, because Social Security recipients can be a little bit more flexible about their spending compared to workers. If the price of gas goes up, then workers have to pay it to get to work, but the retirees can be a little bit more flexible and go on fewer driving vacations. So yes, it does keep up with inflation, but maybe even a little bit more. And I think this may be one of those areas where we might see a potential cut.
All right, we got to keep the ball rolling here. Bob, myth or fact, full Social Security benefits start at the age of 65?
Well, you kind of gave this away earlier in the program. It does not begin at 65. Medicare begins at 65, but for Social Security, those born between 43 and 54, it's 66. Between 55 and 69, it's 66 and some months. And then for those born in 1960 and after, it's age 67.
And finally, Michael, myth or fact, you can work and get benefits at the same time?
Well, you can, but your benefits are reduced if you take Social Security before full retirement age. So know when your full retirement age is. For me, it's 67. Anybody born after 1960, we reach full retirement age at 67. And if we continue to work and earn money above a threshold, and that threshold is about $22,000, then we are taxed. We have our Social Security benefits reduced by $1 for every $2 we earn.
Touche. Nice job, Bob and Michael. We appreciate you both. Job well done, both good sports as well. Coming up, there is plenty of movement on Wall Street after the bell. See who's making the most noise next.
Let's take a look at a couple stocks trending after hours. We got 4 names for you up on the board: Lennar, Freshpet, Guess, and First Republic Bank. Kicking it off with Lennar, looking at gains of just about 3% in extended trading. This move has to do with the guidance that we just got out here from the home builder. They boosted their delivery guidance for the second quarter and also for the full year. The street obviously very excited about that. EPS, their profit, also coming in better than expected. So we're looking at gains of just about 3%. Moving on to Freshpet, a bit of a different story here with the stock off nearly 10% in extended trading. Some headlines here crossing that the company is now looking to raise some financing, announcing $350 million in convertible notes, senior notes offerings here for the company as it does look to tap some financing. So we're looking at losses of nearly 10%. When you take a look at the longer term chart of Freshpet, if we could flip over to that, year to date, we're looking at gains of just about 5%. Over the last year, though, the stock off just about 34%. Let's take a look at Guess. That stock off just about 8% in extended trading. The retailer disappointing the street. Adjusted EPS, it did beat, but this was all about the guidance missing expectations. They do see 2024 adjusted EPS of $2.46 to $2.80. Well, the street was looking for $3.55, so coming up very short there. Over the past year, we're looking at gains of just about 22%. Year to date since January 1st, just barely in the green. Now let's take a look at First Republic Bank. This stock, of course, has been on our radar now for a number of days. In extended trading, we're looking at a pop of just about 12%, adding to the gains that we saw intraday, though, although the gains that we are seeing, that we did see today, coming after a massive drop here in the stock. Intraday closing up just about 26%. But if you look at a 5-day chart, the shares are still down about 65%. First Republic Bank, one of the regional banks that has been caught up in the aftermath, some of the selling that we have seen within this industry following the collapse of Silicon Valley Bank, on Friday, and then also Silvergate over the weekend. Charles Schwab, that stock up just about 0.3%, and Zion's, that stock up just about 2%. Dave.
Jana, thank you. That'll do it for us. Come back tomorrow, 3 p.m. Eastern Time for your coverage leading up to and after the closing bell.